Welcome to Turning Hard Times into Good Times. I am your host, Jay Taylor, and I'm speaking to you here from in New York City on the 18th day of 2018. I should mention to you that this will be the last live show of this year, since Christmas and New Year's Day both fall on Tuesdays, the day that this show airs. As such, the next live show that you will be listening to will take place on January 8th, 2019. I want to thank each of you for listening to this show, making it one of the more popular shows in the Voice America Business Channel. We also like to invite you to keep your questions, comments, criticisms, and praises coming along to questionsfortaylor@gmail.com. Questions, the number 4, Taylor@gmail.com. Would also like to suggest you follow me on Twitter, and you can do that. My handle, Twitter handle is JTaylorMedia. I've become quite a bit more active on Twitter, and you might want to keep up with some of my thoughts on the contents of this show as well as my newsletter. I do want to thank our sponsors for making this show economically viable. Today's sponsors are RN Resources, Novo Resources, Sandstorm Gold, Triumph Gold, Gold Mining, Inc., Uranium Energy, and Klondike Gold Corp. I've titled today's show, Can Gold Shares Rebound in 2019? Dan Oliver, Michael Oliver, and Dr. Quinton Henning are my guests this week. 2018 has been a miserable year for the gold mining shares. From his structure and momentum perspective, Michael Oliver suggests that a tectonic shift is underway for stocks and bonds heading lower, and the potential for a dramatic rise in precious metals may be in store for 2019, as well as the companies that mine those metals. Private hedge fund manager Dan Oliver, who invests in gold mining shares, views the market from a fundamental perspective. He is cautiously optimistic about the gold share markets in 2019. He thinks, he believes, he hopes, he says, that we're headed much higher. But those of us who have been optimistic in the past have been burnt many times, so we are understandably somewhat cautious. One of the most unusual and challenging gold deposits ever discovered is Novo Resources' Karratha discovery in Western Australia. The deposit, which Dr. Henning believes originated in a similar manner to the Great Witwatersrand gold deposit of South Africa, is characterized by an extreme nugget condition that renders usual exploration and development techniques ineffective. An interview I did with Dr. Henning this past Saturday will be aired in the second segment of today's show, right after our first commercial break. Dr. Henning will explain how he plans to overcome extreme challenges in quest of what he believes can be an exceptionally large and profitable gold mining operation. And it is my understanding Novo Resources will likely release assays from a 170-ton bulk sample that was mined from the Egina target in Western Australia. That press release should be forthcoming later this week, most likely, I'm told, on Thursday. Dan Oliver will be with me during the second half of today's show, but I'm very pleased to tell you the other Oliver from another mother, the Oliver we know best on this show, Michael Oliver, is with me right now. Thanks for joining me again, Michael.
Hi, Jay. Happy holidays.
Happy holidays to you, and I must say that you put out a very interesting, most of your, even though you're technical, the way you describe the technicals are interesting. It's fun reading anyway, even if you didn't get into the technicals. So you headed up today's missive that you put out before the market opened this morning, Battlefield Notes. And there you discussed the S&P 500 to a lesser extent, quite extensive discussion of the S&P 500, and to a lesser extent the VIX, T-bonds, and gold. Would you care to share some of those thoughts with our listeners? Where do you think those major tectonic markets are moving next year? And maybe just give us a sense of where you think we might be, what levels we might be looking at next year at this time.
The stock market, the developed stock markets of the world, not the emerging, were the last to change direction. It began more obviously in Europe in terms of our technical work, that is, momentum technical work. Japan and the U.S. is now showing clear signs that it's over. We think the top is in, circle it's done. The issue then becomes, what's the nature, duration of the decline? Is it slow and laborious? Is it layered? Or is there a collapse somewhere, perhaps at the beginning or at the end? Remember in 2008 there was an end collapse. in 1929. It was a beginning collapse, and then came the bear market. We think right now that we've just taken out the low of the year, of course, the yesterday, and again today, the February low, by a few points on the S&P. We think the next support's probably 2,400 area, which is 6% or so below the market, no big deal. But that's a key area because if you don't hold it, there's risk of a crash. And we base that on our analysis of annual momentum of the S&P, which is distinctly different now than it was in 1929 and in 1987. Though I know people like to go back and examine those as, crash templates and so forth. We're in worse condition because our annual momentum structure in the S&P is so well defined as a floor. Well, if you draw a horizontal line under the momentum action, that goes back to 2011 and 2016. Those lows were the same on annual momentum, not in price, but on momentum. If we go through 2,400 by much, we're going to blow those lows out on a relative basis, in which case we open there's a void below us. So while we think the drop right now is likely to go to the 2,400 level, then comes the question, do we hold near there? I have a somewhat of a bias that we don't. We don't even put up the noble struggle of a month or two rally, for example. Now, all the rallies we've had, of the last few months, would have been multiple days, not weeks, if you go back and look at them. We think it's critical that they hold the 2,400 level if they want to live for another month and a half or so on the upside before they then enter the next phase of the bear market. Or they don't hold that. Now, that's a key level. Why? Look what's happened to the T-bond market. It's exploded in the last several weeks, and I think that is a function of shifting of money out of stocks, developed market world, into a cash equivalent that yields something. You can't get any yield out of Germany. You get negative yield out of Japan. So you're left with only one thing, U.S. government bonds.
Right.
It's effectively a cash equivalent, and they're rushing into it. And I think it's a panic rush. Smart money saying, I want out of this stock market. I don't quite know what's going on. Now, the other beneficiary of this, if you'll look at it, and I know there's a lot of smoke on the financial news channels about commodities going down, oil and copper, for example. That's fine. We expected that. They had a very good recovery from their 2016 lows and were due for this decline. But gold, all during that time, has been going up. Ever since the S&P made its high in September and has turned down, gold has been advancing month by month, despite firmness in the dollar, which is masking the gold advance. We think gold has crossed enough hurdles now to where it can start to behave shortly like the T-bonds have behaved. Mainly, by that I mean a more electronic upside instead of gradual arm wrestling upside, more volatile on the upside. And I think we're at the edge of that movement. I also think that the gold miners are a better place to be than gold. Historically, this is true. They're a better place to be on the downside when the gold is in a bear, if you're short. And if you're long, they're a better place to be than gold on the upside. And I think they're about to shift clearly into that mode. And I think they're doing it, in fact, over the last several weeks. If you look at the percentage gain we've had in the GDX, for example, versus the percentage gain in gold. So I think that the gold mining sector is probably one of the few sectors of stock investment in the world that offers great return and very low risk at this point in time.
So 2019, we're just about out of time here, Mike. 2019 should be a banner year for gold shares. Do I hear you saying that?
I think that if gold does what I think it's going to do, which is to take out 5 years' worth of highs probably within the next month or two, I think GDX could easily be over 30, and there's a breakout structure up there if it ever touches 32. In other words, we're right now at 21 plus. Just to get to the highs of 2016, which I think could be achieved fairly quickly, that's almost a 50% move.
All right.
Highs,
all right.
And so that's the place to be.
All right, Michael. We'll have to leave it go at that. We are out of time. Thank you so much for all you've shared with us this year. I wish you a happy new year, and we'll look to talk to you again on January 8th if you're available. Thank you so much for being with us. Well, folks,
it'll be a fun year.